Okay, evening all, and many thanks for joining John and I on what is the first BP Marsh Partners PLC investor webinar. This is the first event that we've presented at, so please do bear with us if there are any teething problems. Given the time available to us, we've tried to provide as useful a synopsis of the company as possible, past, present and future, obviously without giving any future guidance. Chief Investment Officer, I'll be talking as to the background of the company and its history. I'll then discuss investment approach and ethos, which should hopefully then segue into the current portfolio, followed by a few realization highlights leading into the pipeline and outlook. I'll then hand over to our CFO, John Newman, who will talk us the financial performance metrics and results that the management and the portfolio have delivered, which should hopefully lead you to a positive conclusion about the company in general, but its shares in particular. Moving to the presentation, slide 3, which is up, provides a high-level summary of what we do as a specialist private equity investor in early-stage financial services businesses, predominantly focusing on the insurance intermediary sector in the UK and internationally. The genesis of the business was our eponymous executive chairman, Brian Marsh, who was one of the first in the financial services industry to obtain private equity backing at his original insurance firm via Charterhouse Development Capital. This partnership was successful and his firm was ultimately sold to what is now Citigroup. The capital Brian raised personally from the sale provided the seed capital for what is now BP Marsh. Since inception, we followed a similar path of backing people or businesses within our chosen sectors who we think have the entrepreneurial spirit to grow their businesses with our support. The growth of BP Marsh is built on these investments with the proceeds of successful realizations ploughed back into the business for reinvestment. This continued until our IPO in 2006 at a price of circa £1.44. Slides 4 and 5 provide background on the team, which has been together by and large as a unit since 2011, with 1 or 2 additions and 1 or 2 departures. We believe we're a strong team. There's a great deal of faith in the business, what it does, and in delivering meaningful share price growth alongside, where appropriate, dividend growth to our shareholders. As you'll note from slide 6, we've paid an aggregate dividend of 30p per share, or 9.6 million since float, or the equivalent of 21.5% of the float price per share. We've provided the results of this strategy on slides 6 and 7, which details the 3 key areas of our focus: net asset value growth, share price growth, and continuing dividend yield. I believe these slides speak volumes as to what we've achieved since the start of BP Marsh, generally, but specifically over the last 10 years. The stability, experience, and skill set of the team has allowed the company to get to where it is today, and also, I believe, puts us in a great position for the future. Moving to investment approach on slide 8, whilst we have a general focus on the financial services sector, we've unashamedly focused on the insurance intermediary space, where we feel we have a real niche that is only furthered by our approach. As you'll note from slide 10, we feel we bridge a gap in funding in our space that allows us to access unique investment opportunities. We feel our long-term minority investment approach makes us special in what we do, in particular as regards the size of investment we look at. As you'll see when we take a look at the portfolio, our flexibility has allowed us to make investments that no one other than an angel investor could make. And whilst we do see a role for the angel investor, we see ourselves as distinct from them with a rigorous but informed investment approach as we seek to partner with our investments as they move up the rung on the SME ladder. Our flexible specialist long-term approach has allowed us to invest in people and companies that the wider market cannot, and we certainly see ourselves as the first port of call for those businesses or individuals looking for capital in our chosen sector. Turning to the current portfolio, slides 11 and 12, you'll see that this is presently broken down into 3 areas: underwriting agency investments, insurance broking investments, and financial advisory investments. Given the timings of this presentation, I'll try and draw out examples from within the portfolio that demonstrates both our approach and how effective it can be. In discussing the portfolio, I'll try and touch upon 2 areas: the sum of the parts, which from the insurance investments is touched upon in slide 13. As you will note, our insurance investments handle circa 1.4 billion sterling of insurance premium across a variety of product areas and jurisdictions, with slide 14 detailing the locations of each investment. Whilst we're very specific in terms of targeted investments, we do feel that the portfolio spread provides inherent security as evidenced by its long-term and short-term performance. Moving to specific investments, looking at our largest current investment, Nexus, on slide 15, I say this shows our unique ability to structure bespoke positions in financial services businesses. As you will know, we provided £1.5 million for a 5% preferred equity stake in 2014 when the business had a value of circa 30 million. Since then, it's grown significantly, as has our percentage holding and its value. We now own approximately 17.5% shareholding, valued at just under 41 million, which gives an implied 100% equity value to the business of 233 million, approximately a £200 million increase since our investment. We're able to enter with a shareholding few others could achieve or structure, and via our partnership approach, we were able to back the dynamic management team with input and capital that has allowed for a mutually beneficial relationship, which we see continuing. Moving from the largest current investment value to the smallest initial investment amount, slide 16, Stewart Specialty Risk Underwriting, or SSRU. The initial equity investment was £19, I would say, alongside a circa £275,000 loan, which has subsequently been repaid. We backed the CEO, Stephen Stewart, as a one-man startup with a tremendous track record in the Canadian casualty market. And it shows our uniqueness in terms of what we can bring as an investor. This £19 investment is now valued by us at 5.6 million, and the company's grown tremendously since our initial investment, and we continue to see good growth prospects within that business. It might be useful at this point to talk about our network, which we believe is also key to our success. We like to view ourselves as the preeminent capital provider in the specialist insurance space centred around Lloyd's and the London markets. In supporting this assertion, I point to the two previously mentioned investee companies that both came to BP Marsh via our network of long-standing personal and commercial contacts. Personal in the case of Nexus, or in the case of SSRU, our connections with Aon PLC. We were introduced to SSRU by Aon, who previously would have perhaps been the seed investor in SSRU in exchange for their placing brokerage into the London market. This isn't something that customarily they do now at Aon, but we're aware of our appetite of looking at these sort of positions, as the team here made a presentation to the Aon Wholesale London team that handles their underwriting agency business, and after this presentation they referred us to SSRU. We provide one or two further case studies in the presentation, and obviously we're happy to deal with any specific questions on the portfolio after the formal part of the presentation. Turning to realisations, which is the other side of our business, fortunately we were able to announce a realisation last week, the sale of our shareholding in MB Prestige, a high-value motor insurance agency based in Sydney, details of which are contained in slides 19 and 20. Clearly, the numbers speak for themselves over the 8 years, a 29% internal rate of return on our investment, a 9 times multiple on equity invested, and a tremendous investment that really underlines what we try and achieve. That being said, I think we can separate the quantitative analysis of this investment to one side, which the numbers speak for themselves, and look at the qualitative in terms of what we brought to the table by our approach and partnerly position. We were introduced to MB via a long-standing business contact in Australia, who was a non-exec chairman at MB and a minority shareholder. MB, prior to our investment, were majority owned by the Australian private equity company Ironbridge. MB formed part of a larger group of underwriting agencies owned by Ironbridge that had been sold off at that point piecemeal. MB, in isolation, fell below the minimum position Ironbridge could take, and therefore they were looking to dispose of this stake. At the same time, the management team did not favour being owned again by another company. As such, something of a stalemate could have developed. We were able to structure a buyout for Ironbridge, whereby we provided the capital, assume a minority position, with management taking on overall shareholder control. We were able to recognise the inherent value and quality of the management team, and also because of our sector approach, we had a good appreciation of the Australian motor insurance market's intricacies that made it appealing to us as an investment. This obviously culminated in a successful partnership, which ended by way of our introduction to another BP Marsh portfolio company, ATC Insurance Services, a Melbourne-based insurance agency, which was significantly larger than MB. When we invested in ATC, they had premium income of circa 50 million Australian dollars, and that's grown to near 100 million Australian dollars. But their plan, which we backed, was to take them to 250 million Australian dollars, and we saw an opportunity for them to have a discussion with MB when we made the introduction. Turning back to MB, we obviously recognised the shareholder base was following different goals after 8 years, with the retiring shareholder seeking value of a cash exit, whereas BP Marsh and Daniel McNamara, the MD of MB Prestige, were keen to move forward as part of ATC and as such, we're able to negotiate a mutually agreeable part cash, part share transaction so that those retiring shareholders received cash and Marsh and McNamara received equity in the larger vehicle. We saw this as a great outcome for all concerned, with BP Marsh ending up with a 25% shareholding in one of the largest independent underwriting agencies in Australasia, with a committed and focused management team looking to drive significant equity value. Slides 21 and 22 detail the two most recent successful realizations, which again, after the presentation, we're happy to try and address and deal with any questions. In addition to realizations, I would make the comment that our portfolio continues to generate significant interest from outside acquirers, whether that be next tier private equity or trade buyers. We constantly discuss this with management, given they control their own destiny, but recognise that from our position, all our investments are for sale any day of the week, subject to price, obviously. When we do make a realisation, and it's a cash realisation, we try and strike a balance between retaining sufficient funds to support the existing portfolio / make new investments, and to provide for an ongoing dividend stream to augment the operating profit distribution that we're currently making. I hope this is demonstrated in slides 6 and 7, but we don't need to go back to them. In looking at pipeline and outlook, we've got a very healthy pipeline of new business opportunities. COVID, unapologetically from our standpoint, curtailed any new investments, has given the people first investment approach alongside our position as minority shareholders. It really does mean that direct interaction when discussing business plans, lines of business, growth trajectories counts for an awful lot to us, and we do see the value of face-to-face interaction with the teams that we're going to back, because ultimately these could be long-term partnerships, not necessarily 5, 8, but in the case of Howden or Besso, 20 to 21 year successful partnerships. That being said, as we're now returning to what some could term a more normal modus operandi, we have various ongoing discussions with several doable deals. And without further wishing to butcher a cliche any further, our new investments do tend to have a habit of being like London buses, where more than one turns up at any one time, and certainly that may or may not happen here. In terms of the wider market, activity at the bigger end does tend to trickle down to us and impact us and where we are. And without wishing to comment on any specific transactions at the larger end, there is significant M&A activity going on, which we see as both natural for the market in general and positive for us in terms of presenting potential new deals and teams to back. We certainly have the bandwidth and access to sufficient capital to continue on with our tried and tested approach. Before handing over to John, and conscious of timing, I'll finish by emphasising that we at BP Marsh are all very passionate about what we do, looking to achieve, which is a continuation of what we've already achieved, a long-term specialist approach with demonstrable returns alongside a robust growing portfolio and attractive new business pipeline. The key focus of the team here is to deliver shareholder value, the same as we would expect from our portfolio companies. Now I can hand over to John.
Thanks, Dan. So this slide sets out our key financial highlights as reported in our final results to 31st of Jan 2021. So we consider one of the key financial measures for our business is net asset value. This demonstrates how much we've grown the capital assets of what we invest in. So overall, for the last year, our NAV increased by 13 million to just under 150 million, which was an increase of 9.5% over the prior year, despite the COVID-19 pandemic. Operating profit was 13.8 million, which was up 10.7% over the previous year. This profit predominantly relates to the increase in valuation of the investments for the year, which was driven by the equity portfolio, which Dan's given a brief synopsis over. That in itself, the equity portfolio was up just under 11% to 131 million. So given that we don't set exit clauses, and as discussed, we're a medium to long-term investor, we often structure investments as a mixture of debt and equity, although always alongside equity, not just debt. So this enables a yield to be received on the investment, which helps us cover our operating costs. And also debt repayments help to replenish our capital funds rather than having all of our capital tied up into an eventual exit, which for a medium to long-term investor would be a problem for cash flow. So our loan portfolio, which is in addition to the equity book, stands at 17.1 million at the year end. However, we received back 2.9 million in repayments, which was approximately 9% of the total book in the last year. I can also confirm that all of that 17.1 million loan book is up to date in repayments despite the pandemic and is valued at par. So one of our other core strategies is to ensure that the yield from the portfolio, which comprises loan interest, dividend income, and we also place a representative on the board of all of our investee companies and charge a fee for that. So this covers all of our operating expenses so that our investment cash doesn't get depleted by working capital. And on an underlying basis, the profit for the year was 0.9 million, which was up 10% over the previous year. So from this, we decided to make 100% distribution and paid a final dividend of 0.9 million or 2.44 pence per share in July of this year, which was an increase in the dividend of 10% over the previous year, despite not having a realisation. As Dan stated earlier, we seek to find a balance between rewarding shareholders and retaining capital for future and follow-on investments. Including the NAV growth for the year, the dividend paid, that equated to a total shareholder return of 10.1% in the last year. Turning to the next slide, our strong financial record is demonstrated through the group having achieved a compound growth in NAV of 8.2% since flotation and 11.7% since inception. And that's after all expenses, any tax payments, all distributions, and excluding any capital that we've raised on the markets since we came to market. We've currently got 3.7 million of available cash funds for new or follow-on investments, which includes 2 million remaining of a 3 million loan facility. In addition, we anticipate that these funds will increase as repayments are made on our loan book. And although we can't go into too many details, there's a number of initiatives in the pipeline that we hope will come to fruition and increase our liquidity. So our NAV of 149.9 million, that equates to 416 pence per share or 411.3 pence on a diluted basis, including an employee share option scheme. So based upon the closing share price from last night of 323 pence, that's a share price rise of about 32% over the last 12 months, which demonstrates how well we've recovered after the COVID hit. But this still represents a current discount to diluted NAV of 21.5%. Turning to the next slide. To summarise, why invest in BP Marsh? We're a leading specialist investor with an excellent track record, experienced management team, and we provide investors with an opportunity via BP Marsh to invest in businesses that people would otherwise be unable to. Although we specialise in financial service businesses with a specific interest in insurance intermediaries, our portfolio is diversified in terms of product lines and geographically. Although about a third of our portfolio are overseas, about 58% of all revenues across our entire portfolio emanate overseas. We believe this mitigates risk, as demonstrated by our consistent results and solid track record. So this has been achieved through identifying excellent growth opportunities in delivering added value and return to shareholders through NAV growth and then subsequently share price growth alongside a dividend. So we consider the current discount to NAV of 21.5% to be unwarranted. So this concludes our formal presentation. The slides for this will be placed on our website in due course if anyone wants to review them in further detail. There's also a trading update that's being released to the market tomorrow morning, which includes an update on some of the things that are covered here and an update on liquidity. I would now like to invite any questions that you might have.
What does your shareholder register look like in terms of percentage of retail investors as opposed to institutions?
I've not got the total percentage hand, but it is outside of management. We've got Brian Marsh, who owns 40%, management that's circa 5% over and above Brian, 20% just under by PSC. IS Partners own about 1 or 2%, and then the remainder is pretty much within the retail sector. It's something over the last 3 or 5 years that we've focused on, given our long-term approach. Some of the institutional fund managers are almost private equity-esque in their approach of looking at it as a 3 to 5 year investment, get their return, exit the position and go into another position or cash in, whereas that's not our approach, and therefore we saw that there was a potential opportunity to go to the retail investors and say this is what BP Marsh is. We think it presents a very good opportunity for shareholder returns.
Excellent. Yeah, somebody just picked up on that, saying that as you said earlier in your introduction, it's your first time you've done a presentation this type to retail investors. So this is something you've strategically planned in, and you want to grow the retail sector.
Yeah, I think so. I think one, we're very keen on shareholder engagement. It's basically part of our day job when we're managing the portfolio, but we're on the other side of it, so to speak. So yeah, I think the more we can demonstrate the underlying quality of both the investments and the team by good presentations, engagement, collateral that we produce, then it's all to the good in terms of showing that the company in the best possible light to shareholders, and hopefully drive that share price as a reflection of the performance of the company.
Yeah. Somebody was asking me, how do you choose? What is your sort of markers in terms of the companies that you aim to be interested in, as you see?
I suppose it's multifaceted, to be honest, Chris, because obviously we've got, we're rigorous in terms of internal discipline. We have a new business team, an investment committee, a company board, and then a PLC board, and there's interlinked terms of reference that need a tick box approach to get things through. There's the financial aspect that we link in with the finance team from the investment department, where we're looking at the returns. Ultimately, at the get-go, we're looking at the sort of 20 to 30% internal rate of return on all investments just to justify the cost of capital. But then fundamentally, once we've gone through all that, the sort of the private equity approach, it comes down to people that we're backing. I wouldn't want to say what the split is in terms of where we put the weighting, but fundamentally it comes down to the people that we're investing in. It's almost a question of who do we want to be in the trenches with if things don't go right, as opposed to, it's all great collecting the dividends checks and things like that, but these are private companies with different challenges, and we're making a gut qualitative assumption or assessment of what they can do, whether their plan's credible, do they understand their business, they generally believe they do, and are they in a position to be able to make sometimes difficult choices for the best position and total long-term return for shareholder value.
So that leads me on to how does BP Marsh get its investment back, as it were? Is it the plan of is it a 4 year plan, or is there something else?
No, I think that, to be honest, private equity, we generally use all the same law firms and advisors, and the shareholders agreement are pretty standard. We like to see the same shareholder protections as a 3i or LDC would use, but where we differentiate ourselves is that we don't have exit triggers. We're a minority investor, and we like to link up with management, and it's almost a vote of confidence in management that for so long as they see value in the equity of their business, why would we want to sell? We don't always get it right, but if you look at the long-term holds of Howden, for example, that was a 3-man team from another Lloyd's broker that came to us for seed capital. We backed them through various business plans. So I could say that we always start with a 3 or 5 year business plan, but that doesn't mean once that plan's been achieved, we then seek an exit. We then sit down with management, perhaps have a strategy day, then put together the next 5 year business plan. What can they achieve then? So for example, with Howden, we took them through probably sort of 3 iterations of business plans, growing the business to 100 million equity value. At that stage, we thought that was the natural time for us to leave that business. The management thought differently, thought we should partner along with them and 3i, which we did. We took the business from 100 million to 250 million with 3i, and then it just got a bit too big outside of our bailiwick in terms of what we like to see, transaction sizes, acquisitions, and it was a natural exit for us. But that was after 20 years, and we thought we had opportunities to exit all the way through that. But why would you sell an asset that can outperform almost anything else in the market?
Thank you.
I think another adjunct to that is key thing for us is our flexibility. We don't have a one size fits all for our investment approach, and that works very well. So in cases like Nexus, whereas we would nearly always go in with a minimum 20-25% minority holding, we started off with a 5% holding, and we built it up over time. That was all equity. A lot of our other investments, we would split them, as I said earlier, between equity and debt, and that allows us to get some of the capital back over a staged payment. Obviously, we back startups, they might take a little bit longer, although in the case of SSRU, that was a prime example of a business that managed to go and repay its loans in record time. So our flexibility is, I think, one of our key strengths.
Thanks, John. Okay, how do you intend to reduce the discount to NAV? Did you touch upon that earlier on, John?
Well, I think the main essence is, I think, continuing to demonstrate that the valuations that we've got within there are conservative, that we can hit them when we go and make realizations and exceed them. And as we continue to demonstrate that we are building the NAV, that's obviously going to go and help us to reduce that discount alongside engagement. The dividend is obviously helpful from that perspective, and the realisation will enable us to pay out higher dividends. So that all together will enable us to go and narrow that discount, because it's in everyone's interest. You know, we've all got shares. We want to see the share price grow and that discount narrow.
Excellent.
Yeah.
Okay. Well, okay. Any other comments to make, Dan? I think we've run out of time.
No, well, I think that's perfectly correct. I mean, we're in an issue. The issue, there'll always be a question mark over the discount, because we're investing in private companies, and there'll always be a question mark over the realization. Our goal is to make that discount as small as possible. But you know, there is the counter argument that I would always make, is that these are investments that the public markets cannot get hold of, and therefore deliver better value, and that should add to it as well. But that's on us to make sure that people are aware of the blue chip nature of the portfolio by and large.